Are we in a credit bubble?
It's a very, very perilous time for credit right now. There's a lot of economic uncertainty. Earnings growth is challenged. We're seeing more and more dislocation, particularly in the middle market. But I think that it just expresses that fundamentals and doing your underwriting is more important than ever.
So that doesn't sound like a bubble.
The first question I get from investors in every single meeting since 2011 is, are we in a credit bubble? So, we're 8 years into a pretty deep cycle. I think, the memories of 2008 still are resonating in people's minds.
Vivid, right?
Vivid in people's minds. And everybody's kind of waiting for the next big downturn. So I'm not saying that you shouldn't be cautious, but, we do think there's pockets of value within the credit business.
There does seem to be a big difference between what's going on in liquid credit and what's going on in illiquid credit. Give me your assessment.
Yeah, so much of our system now is based on, because of regulations, are so much based on ratings, capital charges. So because of that, the difference between liquid and illiquid risk is still at very, very wide spreads. So we think the best opportunity continues to be in illiquid credit, and we find it very, very challenging to find value in liquid credit.
Even with all of the money rushing in to the private credit industry.
Yeah, I think the thing that people miss is how much money has come out of the illiquid credit business. And so, 87%. So in middle market lending, for example, banks had an 87% market share in 2007, and today that's 4%. So our biggest competitor used to be Wells Fargo, and now Wells Fargo is our biggest financing provider. So it's more capital efficient for them to lend us money to make loans to companies than it is for them to do it themselves. By average.
Have credit originators lost discipline yet?
We don't see in the middle market. I don't want to talk about large market. In the middle market, we haven't seen a lot of bad behavior, and we haven't seen people get very undisciplined. In the liquid markets, I would say, because there's less differential based on fundamentals and more focus on things like ratings, I think you're seeing a little bit more inefficient behavior in the liquid markets.
It was nice to see the credit market get a whiff of peril in WeWork before the equity holders came around and recognized what was going on, or at least the potential equity investors. JP Morgan was shopping a $2 billion 15% PIK deal. Would you have bought that?
So it's a great question. So, we are all trained for 20 years in things like cash flows and EBITDA and fixed charge coverage ratios, and our market has a really, really hard time valuing things that are, enterprise value but not cash flows. So WeWork's a perfect example. So WeWork through the subordinated bonds was $3.7 billion in value, and you could generate 15% returns with upside up to 30% returns, so equity-like returns. And the reason it prices at that level is because there's not a lot of people, in the traditional credit markets who can price this stuff efficiently.
But now Softbank has come in with this $9.5 billion rescue package. Softbank is supposed to be money good, and yet WeWork is still trading at a 13% yield. Is that a buy?
I won't opine specifically on WeWork because I wouldn't say I'm an expert on real estate, but you're dead right. You see it all the time. You see big disconnects on tech businesses or allegedly tech businesses between the equity markets and the debt markets. The equity markets are much more comfortable valuing these things, or venture capital, or people like Softbank, versus the credit markets. So it's been a perpetual issue over the last couple of years where you've seen big disconnects between debt and equity markets on value.
Where do you see, if you look across the credit spectrum, and in particular into illiquid credit, which is where you're active, where is there value?
We see value in basically two places. One is originating or buying illiquid assets and making them liquid. So getting a CUSIP or rating, or making them, turning something that's illiquid and making it give the optics of liquidity. You can collapse the spread between illiquid and liquid risk very, very quickly doing that. So that is one big theme that we're pursuing today. So we're not taking examples. So we bought a loan at 10% that was unrated from a large bank that was just sitting on their books. We got it rated, and then we monetized it to an infrastructure fund at a much lower spread. So just getting that rating, or just creating a CUSIP or doing something else, really collapses that spread between illiquid and liquid risk.
You are your own catalyst, effectively.
It's funny you say. I call it creating your own catalyst. So, we're not making a bet on the cycle or on fundamentals or other things. Like, we're buying loans we'd be happy to own at where we're buying them, but trying to create a catalyst to get an improved valuation.
So that's one pocket of opportunity, turning illiquid credit into liquidish credit. What's the second?
Our business model, because obviously we're attached to a big private equity firm, we obviously can provide a lot of value to companies. And there's a lot of companies out there who don't necessarily want to sell control. So they want institutional help in things of M&A and our ability to help them take their business to the next level. So there's a big opportunity to do what we call value-added lending, which is lend money to companies, but act almost like a private equity sponsor. So bring all the benefits of a private equity firm, but do it through debt.
I love asking this question of credit people who work for private equity. Are you surprised at the terms at which other credit providers are willing to give money to your private equity partners?
I don't know. I mean, obviously, if you look at where things are priced today, most private equity firms, not just BC, are being pretty cautious about how they're levering opportunities. So it's not uncommon for a firm to buy something for 12 to 15 times and only lever it at 6 times. If you look back at 2007, people were levering stuff to a 92% debt to enterprise value. And I think people I think everybody's abundantly cautious about putting leverage on companies. So yes, people are providing covenant-light instruments, and yes, they are pricing them at low levels, but they're also, well covered by enterprise value in many cases.
Before we finish, how does your credit portfolio perform in a 2% GDP recession, and how does it perform in a 5% GDP recession?
You mean -5 or -2?
Minus.
I mean, listen, most of what we do is first lien. So the average LTV of our portfolio today in our opportunistic business is 55%, and my lending business is 40%. So we would have to, to have material impairments, we'd have to go through a pretty big cycle. And we're not macroeconomists, but we just don't see a negative 5% GDP scenario.